I think
That's
the
a
main
good question.
thing would be building for the long run, in an industry where there's so much volatility and especially around this current macroeconomic environment, it's important that you're building something you believe in over the long run, like 5+ years to keep you going and you're not in something for a quick buck, which is, much harder as things are in a down market.
Hey everybody, Tanner here with WAGMI Ventures. On today's episode, we have Himanshu, Sahay, and Dhruv Patel, both co-founders of Arch. For anyone who's new, this is the WAGMI Ventures podcast, where we do snapshots with interesting founders from across Web3. Check out wagmiventures.io to learn more about the syndicate behind the podcast. But for now, let's get into it with Himanshu and Dhruv from Arch. All right. Hey, everybody. I'm here today with Himanshu Sahay, co-founder and CTO at Arch, and Dhruv Patel, co-founder and CEO at Arch. Guys, how's it going today?
Doing well. How are you?
Yeah, doing really good. I'm excited to chat today. And maybe here just to start, I'd love to learn a little bit more about where you guys are coming from. So what have you been up to before Arch? Can you give us a quick snapshot of your stories?
Yeah, definitely. I can go first. So I had a background primarily in consumer social. I like to say I've worked at all the apps on your phone, but I really began at Tinder working on Gen Z products there. So I was there for a while, joined an early startup at the time called Bird Scooters, which rode the whole scooter boom, and then joined Snapchat, where I was for a couple of years building ad products. At the same time, had been investing in alternative assets, primarily in ventures, being an angel and helping funds, and also a little bit of crypto, and met Dhruv that way. I'll tell you the story from there.
Yeah. And my background is all in financial services and fintech. I started my career off at Bridgewater Associates. And after that, I left to join a fintech startup called Brex early on. I spent a couple of years across a variety of different roles, capital markets, operations, and credit. We're really getting a good sense of what it takes to launch and scale lending products. And as Himanshu alluded to along the way, we sort of were both investing in quote alternative assets, cryptocurrencies, equity in early stage private companies via angel investing and other asset classes as well. And what we saw both in our personal lives as well as in the folks around us was that as our portfolios started to be more and more skewed toward these asset classes, it became harder to access debt, just given traditional lenders and banks didn't know how to account for these assets. And so that was really the genesis behind Arch. And that's what we're building. We're building a set of financial services and software for individuals with alternative assets. The first product is lending, which we launched earlier this year. So individuals can come and take a loan against their crypto assets. And over the course of the next few months, we'll be supporting additional asset classes as well. So you can come and borrow against your equity in a high value private tech startup, real estate, what have you. We look more and more like a tech-enabled private bank and wealth management service.
Love it. So can you guys talk a little bit here just early on about some context, really just like market context or Arc relative to other players in the space? If you had to kind of boil down for listeners, what makes you guys distinct? What would you kind of index on there?
Yeah, there's a couple of things, and Himanshu, feel free to add anything I missed. But At the highest level, I think a few things that differentiate us. One is the fact that we are regulatory and legally compliant focused. That means we're a US-based company. We partner with first-in-class partners across the board. So for custodians, we work with BitGo. They also have a US-based trust, which is where our customer assets are held. We don't rehypothecate customer assets, which is a big part of our business model. And actually, what led to sort of the demise of other centralized crypto lenders. You can think of Genesis, Celsius, Fly, and the likes. And I think the other sort of differentiators for us outside of the user experience is really the way our product works in the sense that an individual can take out a loan against their whole crypto portfolio. So they can cross-collateralize their Bitcoin, Ethereum, and other tokens as well, and take out one single loan with one interest rate and one monthly payment so that it's much simpler for them to manage the debt that they have.
Love it. Super interesting. You mentioned just now that you guys basically don't kind of touch or reloan customer funds for any reason. Sounds like given some of the liquidity issues of other crypto lenders, like the ones you mentioned, BlockFi or Celsius, et cetera. So tell me a little bit about the thinking and mechanics there, as I'm sure, the traditional crypto lender playbook has some upsides that may have been a little more challenging to sort of rethink or repudiate.
Yeah, I think essentially the reason our model is different is when you look at the way the other folks were doing it, they were essentially taking customer deposits and then further lending that out to generate a yield on those assets. For us, that's really not the business model we're in. Our revenue source on lending is the interest income that individuals are paying on their loans. And we source our capital for lending from both venture capital that we've raised as a company, as well as debt from credit funds and other sources, maybe like DeFi pools of capital. And so I think for us, we're just structurally different in that respect, which makes it such that we can still operate a business without needing to rehab the customer funds.
I think on a macro scale, it's important to understand the difference between traditional banks that rehypothecate successfully and in crypto why that's not quite figured out yet. In the traditional banking system, you have, at least in the US, the fractional reserve system, and then you have FDIC insurance. So if a bank is lending out 90% of deposits, that is insured by the federal government. Versus in crypto, there is no such insurance. So if you have to pay back your customers and the funds are lent out and you can't get them back, then you're really stuck in a difficult position in crypto, which hasn't been figured out yet. I don't think we're fundamentally against safe and trustworthy rehypothecation, but I just don't think that exists today. And we'd like to really build a trustworthy business here, which I think cannot be built with rehypothecation today in the ways that it has been done. Maybe there's a better way to do it, and we're open to figuring it out in the future.
Makes sense. Yeah. So I'd love to hear some of your reflections on the journey thus far. So, maybe first, like early challenges, what were some of those and how did you and your team think about solving for those challenges?
Yeah, I think for us, it's been interesting. We started over a year ago, but as you can imagine, one of the challenges for us has been customer trust and security. And if you look back over the past year, essentially every 3 months, there's been some big blow up in the crypto world. So you started with Luna, then months later you had FTX, BlockFi also, Celsius, Voyager, etc. And what that has really done is eroded customer trust. There's many customers that still have deposits locked up in these institutions and can't get access to their funds. And so that's been the challenge that we've been working to overcome is how do we really tell customers and show them that we don't rehypothecate their funds, that we are operating the way we say we are. And, there's a lot of things that go into it, from how we market our product to really some of the product features that we're working on to be able to show customers exactly what we're doing.
There's been a lot of talk of proof of reserves lately. I don't think that's enough personally. There should be reserves, liabilities. Solvency is another proof that's out now. And I think in order to prove that you are, at least at the lender, you are in good health, you really need all three. And I think as CeFi players come under more scrutiny, they will need to implement these in the medium term.
Yeah, that makes sense. So similar question too. Instead of challenges, I'm curious about surprises. So specifically, like you've already mentioned, last year was such a tumultuous year. I think a lot of people could probably guess what some key surprises have been, but maybe specific or local to your particular company, what were some key surprises and how have you and your team adapted to those surprises?
So I'd say in terms of surprises, even throughout sort of this volatile economic environment, there's been a consistent amount of demand. And for us, we weren't sure what to expect, especially as you saw many of these companies going under. But we actually saw a fair amount of customers come inbound from them saying, look, we still need loans against these assets. And as a result, I think that was something that we weren't truly expecting, and it was unclear how it would shake out. For us, there was a fair amount of things that we still have to do to be able to handle the demand, especially as it relates to capital for lending purposes on our side. But I would say that would be the key surprise that we faced.
And I think on the capital front, we've noticed that DeFi pools of capital like RWA lenders are more comfortable understanding this collateral base and lending to us based on that versus some private credit funds that maybe price it a little differently just because they don't understand it, even though this is over collateralized lending with auto liquidation and other such parameters that make it much safer than like a traditional uncollateralized loan. But that's been interesting to kind of explain to these people that, hey, this is different from what you expect. This is quite safe. Here's our architecture. Here's how we're structured. And here's why you're going to get paid back as we say you are. And I think we've seen certain changes happen throughout the year. So when we began, centralized lending was was huge. There were a lot of big players. The last big one that we just saw just closed operations last week, which is Coinbase. They just announced that they're ending their product on May 10th, which is in a couple of days. And then in addition, we've seen that there hasn't really been much activity on the centralized space because people are just scared in building another centralized lender. And that's the thing where we see a massive opportunity for us to really come in with smarter underwriting and with just a well thought out product that works and plugs the gap of all the other lenders out there. And on a completely different note, we have another product coming out for loans against equity in high value private companies. And we've seen a significant amount of inbound on that product without ever going to market on it. We just simply have a call, a schedule a call button on our website for that product. And we've seen a ton of demand for people coming in and asking for that. And I think the reason really is that now with us being in a bit of a down market, we aren't seeing companies exit or go public at the clip that they used to. So a lot of people have a significant amount of their net worth in these illiquid assets that are going to stay liquid for a little bit longer, and they need to get liquidity against them.
Yeah, I love it. So you guys talked a bit earlier about the regulatory piece being kind of a key attribute of your differentiation. And I think as of this past January is where I read this, but it seems like you guys are legal in 31 states. So I'm curious if you could talk a little bit about how the regulatory regime works for nascent crypto lenders right now and why you're going state by state.
Yeah, definitely. So I think there's a few paths that you can take here. One is working directly with a bank and, having a lending program in tandem with them so that you can leverage their sort of like compliance and legal standings across the US. For us, the other path, which is the one Arch is going down, is really being in compliance with each state itself as a personal lender. And with that, the various states have their own requirements as to when a license is required, what the lending sort of parameters need to be in terms of interest rates, loan sizes, things of that sort. And so we're navigating that with our law firm. And that's why we're currently active in 31 states and will be active in the remaining states as well throughout the rest of this year.
Love it. That makes sense. I'd love to learn a little bit more about both of your feelings on the state of crypto in general right now. So obviously what you're building speaks to one element you feel is a missing ingredient in the space. Otherwise, you wouldn't be building it. But I'm curious what else from your vantage point you think the space could do better in or improve in.
Yeah, Himanshu, you want to start and then I can tack on after?
Yeah, I think, and I hate to keep coming back to this, but I think we really need more clarity on regulation. And I've said this in every avenue I've had over the past few weeks. I think at least in the US, we don't have a clarity on what regulation is going to be on these assets moving forward, whether they're securities, whether they're commodities, what licenses do people need. And I think it creates a uncertain environment, and that has blowback on all the different industries that interact with it. So with lack of clarity on the asset class, traditional banking is going to be less inclined to work with this asset class. Customers aren't going to be sure of its long-term viability. There's just a whole level of domino effect that happens because of lack of clarity. So we really need stronger regulation. We really need regulation to come in and fix the issues that happened last year in a constructive manner that doesn't stifle future innovation, but actually enables it. We're seeing a lot of this happen in other countries that are more crypto forward, like parts of Europe, in the Middle East, in the UAE, in the Bahamas and such. So I think that would be a really great thing to happen in this industry. And I think I heard this somewhere recently. There's a lot of demand in crypto when things are going up or going down. There isn't a lot of demand when things are going sideways. And we've been in a sideways motion for the last 6 to 8 months. So it would be interesting and it would be good to see movement in either direction, hopefully up.
Definitely. Okay, so one question that's become a recurring question kind of on this podcast, where if I were to say the future of crypto is blank, how would you fill in the blank? Or, in other words, kind of a similar question as the last one, where, what are the most important or most exciting directions you see happening in crypto from your kind of unique vantage point?
Yeah, I think one trend that I'm excited about and us as a company at Arch, we're excited about is the digitization of assets. And here, what that would enable is, let's say you have digital representations of real estate, things of that sort. Obviously, there's a lot of legal work to be able to make sure that the tokens can actually represent ownership in the real world. But what this would enable is easier transactions or easier ways to borrow against these assets because you have more pools of liquidity to access. And so I think that's one trend.
Yeah, I think increased liquidity across the board is going to be great. On the lending front, in the short term as well, we're seeing lack of liquidity just because of lenders going under. But it would be great to see more of them spring up and service the liquidity needs of customers out there because there's a lot of demand. There just hasn't been enough supply.
Yeah, that makes sense. Okay, guys, maybe two last questions here. First question, I'm curious your advice for founders building in the crypto and blockchain space right now, where I know you guys are, about a year into this, but if you could go back a year ago and maybe impart some advice to yourselves, what would you want to tell yourselves?
Building for the long run, in an industry where there's so much volatility and especially around this current macroeconomic environment, it's important that you're building something you believe in over the long run, like 5+ years to keep you going. And you're not in something for a quick buck, which is, much harder as things are in a down market.
Yeah, I think in tandem with that, another thing that has been interesting for us has been just to realize that half the battle is just taking it out and surviving and when everybody else is going down. So if you can maintain your burn, maintain risk, have some revenue, and just attack your problem strategically, so you are in fact building for the long run, you will not go down with the waves of companies that do go down. We've seen now 2 waves of competitors go down. The first was all the centralized crypto lenders last year. And then now very recently, we've seen a number of companies that lend against equity in private companies that have gone under with FRB and SVB and such. So I think it creates massive opportunities for anybody left in the space. And as sad as it is to see those companies go under, if you can just stick it out, it creates a huge opportunity for you to capitalize on picking up the scraps when that does happen.
Yeah, I love it. Okay, guys, what is your team working on right now? And what's the best way for people to follow along on the journey?
Yeah, a couple of really exciting things we're coming up with. First is a risk managed insured from cold custody staking product for loan collateral. So really what this enables is, let's say you have a loan that's being charged 10% and we can stake your collateral at say 5%. It gives you the benefit of essentially not paying much or anything in interest because that normalizes and it becomes almost like a self-repaying loan. So we're working on building that as an opt-in feature. Another thing we're looking at is as we go towards other asset classes, the one we've seen the most demand on is equity in high-value private companies, so loans against that. These two should be coming out in the next couple of months. Anything else I missed?
No, I think those are the main ones. And then, our customer set can expect a non-lending financial product as well throughout the remainder of this year.
Yeah, and I think if this excites you and you'd like to reach out, either schedule a call or sign up and go through the flow. It's very simple. You can go from signing up to having a loan in your account in under 5 minutes, including KYC. You can find us at archlending.com. That's ARCHLANDING.com. You can reach out to either of us as well, Himanshu at archlending.com or Dhruv at archlending.com. And we're also on Twitter and LinkedIn under the same names.
Yeah, and just one correction on the spelling of the website, ARCHLEN, lending, LENDING.com.
Yeah, sorry.
Perfect. Guys, thank you so much for the time. This totally seems like an opportune time to be building what you're building. And so I'm excited to follow the progress. And thanks for coming on the show. Have a good rest of your week here.
Thank you, Tanner.
Thanks, Tanner.
All right. Bye-bye.